Welcome everyone. I'm just going to, I can see that there's a number of people joining us now. I'll just leave a little bit of time for everybody to get connected on. Okay, welcome everyone. I can see some people still continuing to join us, so I'm just going to wait a few more seconds. All right, let's get started. Welcome everyone. My name's Michelle Griffiths. I'm here to take you through this presentation and try to get you excited about superannuation. I know that's a big ask, particularly when it's such a beautiful day outside. So I'll endeavour to make this as entertaining as possible, but most importantly, to actually give you some really good quality information. So the session that we're going to be going through today is Maximising Your Superannuation. As I said, I'm Michelle Griffiths. I'm one of the partners in the Investment Advisory and Wealth team here at TAG, but I also am very active in the superannuation space, particularly in educating accountants, financial planners, lawyers in this space in relation to strategies and all things superannuation. So you're in good hands today. I can see we've still got lots of people joining us, so thank you so much. I'm really excited about sharing some of this information with you today. So just a bit of housekeeping before we get started. You will see on your screen there will be a chat box. If you've got any questions as we're going along during the session today, I'm very happy for you to be as interactive as you want to be. So if you want to ask some questions, please do. I love getting questions. It makes it more interesting for both you and me. So please don't hold back on any questions that you may have. I've also got a recording of this webinar that is actually going to be sent out in the next, well, probably later on today, if not early tomorrow morning. So if you miss anything, if you want to go back and revise what you've seen, then you've got every opportunity to go and have a look at that. Or if you want to share it with your loved ones or colleagues or whatever, feel free to spread the love. Okay, so as I said to you, if you've got any questions, make sure you're using that chat box. First of all, I want to talk through our disclaimer. So basically, whilst I'm going to be talking about the superannuation topic, and that is actually technically a financial product, this is not financial planning advice to you. It is not personal advice. This is general in nature. This is me actually just giving you some ideas, talking about what the rules are so that you understand the framework. So please don't take this as personal financial advice. Okay, so our agenda for today and what I want to be able to cover off during our session today is obviously the first thing is why focus on superannuation. The second thing is different ways to contribute to super. There are a number of different ways that you can get money into superannuation. So we're going to explore what those methods are, some of the rules associated with them, and some, I guess, just some tips and traps associated with that superannuation system. And also then, obviously, the opportunities and planning opportunities come out of that. So why focus on super? Well, before we actually get into this slide that I've got here, which is showing you the time value of money, which I will go into in a second, what I want to do is actually just highlight why superannuation is actually an important vehicle for you. And regardless of the word or how interesting or not interesting it is, the reason why we get excited about superannuation is because it is a wonderful, flexible investment vehicle for you to be able to have money in your retirement that is taxed in a really, really concessional way. So where if you have shares in your own name, you will get taxed on the income on those shares at your marginal tax rates, which can be quite high. Okay, you can usually earn as a retiree about $20,000, $24,000 a year and not pay any tax, just with all the credits and LIFO and FIFO and this, all these sorts of rebates that you can actually get. However, in the superannuation environment, there are basically two tax rates that may apply to you. The first one is when you are in what we call accumulation mode. So that's when you're contributing to the super fund, you're adding to it actively. The tax rate on your concessional contributions, and I'll take you through what they are shortly, is 15% flat tax rate. So that's the tax rate on those. If you are a significantly high income earner, I'm talking over $250,000, possibly $280,000 a year, there may be an additional tax on some of the superannuation contributions that you're making, but that's not that common, and we just need to look at those circumstances quite individually. But the general rule is 15% tax on your super contributions as it goes into the super fund area. The earnings, whilst it's in accumulation mode, they're also taxed at a flat 15% tax rate. When you retire, and if you are over the age of 60, you can turn on what we call an income stream. Call it a pension if you like, from your own superannuation monies. Once you do that, whatever the balance of the fund that is allocated to that pension account, the earnings on those investments actually goes from a 15% tax rate down to a 0 tax rate. So that's actually really powerful, because if you think about the fact that you then have dividends from shares, that you might have imputation credits attached to them, you may actually have a situation where the super fund environment, you're actually getting tax refunds rather than paying any tax at all. So that's why we get excited about making sure that in the lead up to your retirement, we have utilised the superannuation system as much as we possibly can to get you what you want in your retirement. Okay, so that's why we focus on super. Unfortunately, there's a lot of rules about how much you can put into super at one time, and we're going to go through those limits shortly. But what I wanted to show you here is the time, the value or the importance of time in this equation, and why it's important to focus on super and not leave it too late in your planning journey to actually start thinking about this. The example I've got on the slide here is actually showing what the time value of money could be if you had your normal superannuation going in, and that's the SG contributions, superannuation guarantee contributions, going in and starting at age 37 and finishing at age 62, say, you've got the capacity in this particular example to get about $1.4 million in super at the age of 60. By simply adding an additional $100 per week for that whole entire time, that would potentially get your balance from 1.4 up to 1.82 mil. So that's a $420,000 difference over that period of time. Now, having said that, but you're only sacrificing $119,000 worth of your disposable income over that period of time. Now, why is there such a difference? Number one is the fact that it's the time value of money. It's the fact that the earnings inside that superannuation environment are compounding over time as it's earning and basically reinvesting. The second reason is because the amount that you have to sacrifice in order to get $100 into super per week is actually not $100. You're actually only sacrificing the difference between your marginal tax rate and the $100. So, for example, if your marginal tax rate is 32%, then you've got $100 less the 32% that you would have actually paid in tax before it came out to you. So you're actually only, I'll call it, sacrificing $68 per week in that example. But what's going into the superannuation fund is the $100 less the 15% tax on it. So you've got $85 going in, but you're only missing out personally on $68. So that tax differential, and I know that sounds like small amounts of money, but when you say it on a weekly basis, maybe it's a monthly basis, whatever the regularity of that sacrifice is, it's a reasonably modest sacrifice, but you're getting a lot more bang for your buck by getting that money into the superannuation environment in that way. So it's actually almost like a double whammy effect. So that's why being able to start as early as you can actually be really important. For those of you who are joining us who are a little bit closer to your retirement date or your retirement age, it might be that this is the sort of thing that you start to encourage the next generation to be more mindful of, because that time value of money really is so important. Interestingly, just looking at another example showing the same concept of the time value of money, because I get a lot of people who get worried about, or they're worried about the impact that the investment markets will have over time. And they're a little bit distrusting of their ability to make good investment decisions. What I wanted to do is just show you and share with you this particular slide, which just shows you the difference between a balanced investor and a high growth investor. Now, those definitions are actually quite important to understand. A balanced investor is essentially where or at least our definition of it, is that you have invested approximately 60% of your monies that are in the superannuation fund, in this example, in a balanced fashion. And that means that it's 60% in growth assets and 40% in defensive assets. Now, you might well ask me the question, well, what's a growth asset and what's a defensive asset? A growth asset is essentially a share, a property, international shares, infrastructure. They're basically assets that by their nature are designed to grow in value and generate income for you. Now, the nature of growth assets is they tend to be a little bit more volatile. In fact, a lot more volatile. They will go up and down, but the general trajectory, as long as you stick with quality assets and you've got that long-term horizon, is that they will generally perform much better over time. The defensive assets are your things like cash, term deposits, fixed interest, and generally speaking, they will be more yielding, so low yielding, but they will have interest rates attached to them, but there's not a huge amount of income, and they have very little growth. Okay, they might be very stable and they have very little risk and they do not have as much volatility, generally speaking, but they're safer, but they also don't perform as well over time. Now, the balance of how much you have in each of those is a very personal decision. And this is where you need to talk to your financial planner about where you fit in this scale and what's appropriate to you. Balanced is where we find a lot of retirees tend to be in that balanced category. You want to take a bit of risk so that your money is actually working for you, but you don't want to be too risky. Okay, so you want to have a bit of defensive and a bit of growth. And that 60-40 split tends to be quite a common example. For younger people where you've got more time, growth or high growth might actually be quite appropriate for you as well. High growth is 100% in growth assets. Growth is what we call 80-20, 80% in growth assets, 20% in defensive. What you can see there is over that age 37 through to 60, so the same, I'll call it example as what we were using before, the difference between a growth investor and a high growth investor is about $415,000 over that period of time. Now, these are significant changes, but not at the time. It is the time and the importance of time with these criteria or these differences that can actually make a difference over that journey. So these are just some things that I want you to be thinking about in relation to what can I do to make my superannuation situation look better. Okay, so that's that. Some strategies to think about that I guess embody those last two slides is what we try to focus on is making sure that you plan with the end in mind. Now, what does that mean? It means that you have to actually set a goal or a target of where you want your superannuation, where you want your savings to be in order for you to retire. Now, in order to be able to set that target, you might have to go through a process. We have a process which I'll send you some information about in the follow-up email to this session that's called our projections process. It really helps to narrow down and actually help you get that target of what do I need my wealth to be in order for me to be okay in retirement. I'm not going to go into that in any great detail. I'll send you some more information about that. But it's really important to set a goal, set a target. Now, that can be a bit stressful for some people because it's about putting it out there, what you want to get to. I'm here to tell you that I have so much anecdotal evidence of the fact that setting a goal and having a target will actually get you a much better result in the long term than just floating along and doing the best you can. And it's purely because if you set a target, and let's just say you set a target at $2 million, just to pick a number, even if you don't reach that target, you'll probably get a hell of a lot closer to that target and that number than what you would have if you hadn't have had a target to begin with. The examples that I see is where you might not get your target, but you get to $1.8 million instead of the 2. But if you hadn't have had a target altogether, you probably would have only gotten to about 1.2. And 1.2 possibly isn't going to be enough for you to retire on, which means you possibly need to keep working for another 5 years in order to have the retirement that you actually deserve. So this whole concept of setting a goal and being able to establish a target for yourself, absolutely critical in your planning mechanisms. So please do think about that. Contribution caps. This is what I want you to talk, what I want you to understand next. And this is basically the government is limiting, and this goes back to my first discussion about why superannuation is actually so attractive. It's because it's so concessionally taxed. Therefore, the government don't want it to be abused. So what they've done is they've put in place these limits on how much you can get into superannuation at any one time. There's essentially 2 limits that we need to be working with here. One is the concessional contributions. They are the ones that someone is getting a tax deduction for, whether it's your employer, whether it's you personally, but someone is getting a benefit and therefore a tax deduction outside the superannuation system. Therefore, inside the superannuation system, we therefore have to pay the 15% tax as it goes in. That limit used to be $25,000, but from 1 July 2021, that limit was increased to $27,500 per annum per person, okay? So that is the limit. There is no limit associated with being able to put that in other than up to age 67. You can continue to make your concessional contributions, but after age 67, you must satisfy a work test in order to be able to continue to make this particular concessional contribution, okay? So the other limit we've got is the non-concessional contribution. What that is basically you giving your own money, so post-tax dollars, into superannuation. It's tantamount to you gifting your money into the superannuation system, if you like. You don't get a tax deduction for it. It's not coming from your employer, so they're not getting a tax deduction for it. And as it goes into the superannuation fund, the super fund is not getting taxed on receiving that money either. So that 15% contribution tax does not apply to your non-concessional contributions, okay? So there is a limit. It used to be $100,000 from 1 July 2021. That limit has gone up to $110,000 per person per year. You can make that contribution up till the age of 75 without having to satisfy any work test. That's only a new rule, but that's what the rules are now, okay? Now, one limit that we do need to be mindful of is that if you have a total superannuation balance, a TBC, of more than $1.9 million, that's the current limit, then you can't make any more non-concessional contributions. So they're the main limits that we're talking about with that non-concessional contribution. There's also an additional rule in relation to these, and that is if you want to, you can actually bring forward 3 years worth of that limit and make a contribution in one hit. So for example, you might be just retired and you might have a large payout of your annual leave, long service leave. If you're in a business that pays bonuses, there might be something like that going on. You might actually have a lump sum that you want to be able to put into super. So you could potentially utilize this bring forward method to put up to $330,000 in one financial year. Once again, don't forget it's per person, okay? So that's actually something that we use quite actively, particularly as people are getting a lot closer to retirement. Okay, so going back to the concessional contributions, I just want to go through this in a little bit more detail with you. The concessional contributions will include your superannuation guarantee charge. So that is now at 11% of whatever your ordinary times earnings, or your salary, if you like. It will also include if you have salary sacrificed contributions via your employer into superannuation. Okay, so all of these are falling under the banner of a concessional contribution. And this is the $27,500 limit that we need to be working with. Okay, there is the ability now to be able to make a personal contribution. So you make the contribution to super to get yourself up to that $27,500 limit if you wish, or below that, but you need to make sure that when you sum up all of these different concessional contributions, the total is not exceeding the $27,500. Okay. So if you make a personal contribution and then you personally want to claim a tax deduction for that, there is what they call a Section 290-170 form, or a notice of intent to claim that you need to lodge with your superannuation fund before you claim that tax deduction in your tax return. You need to make sure you get the timing right, but that is a possibility. You want to know a little bit more detail about that, get in touch with me. I'll send you some more information. The other mechanism that is available with these concessional contributions, and this is particularly interesting if you've had a number of years where you've not made superannuation contributions, there is this thing called a catch-up contribution that you can make. It's basically a mechanism where we can go backwards up to 5 years. And basically, if we have not used all of our limit in the past 5 years, we can do a catch-up contribution. Now, this is an example that I wanted to walk you through to show you what that is and how that works. The reason why this catch-up contribution can actually be really interesting is that it can help you to boost your superannuation, particularly if you've had a period of time where you've not been earning a lot of money. The one that comes to mind is where a lady or a man goes off and has a period of paternity leave or maternity leave, and therefore you're not earning as much in that period of time. Therefore, your employer won't have been making as much in their superannuation contributions. And you then, when you come back to work, you might want to do some catch up. Okay, so that's one example. It could also be that you've got one of the spouse that is a low income earning spouse has not been making very many contributions to super. And it might be that there is an asset that is sold, that there's a capital gain on, for example. You can use the catch-up contributions to help mitigate the tax on that capital gain, perhaps. So it's actually really useful for those one-off capital gains tax events. Now, another condition in order to be able to use this particular rule is you have to have your total superannuation balance under $500,000 at whatever the previous 30 June was. Okay, so if we're now in the 2024 financial year, it'd be whatever your total superannuation balance was as at the 30th of June, 2023. Okay, as long as it is under $500,000, then you might have access to these catch-up contributions. So that's an interesting trick that you may wish to use. I've got an example here on the slide where I've just used an example of actually using these catch-up contributions where you've got a capital gain. And in this example, there is actually no other taxable income in the hands of the person who's making this capital gain. Not uncommon. Once again, you might do this when you've retired. So in this example, you might have a capital gain of, say, $195,000. If you had if you'd have basically used the super deduction and done a bit of a catch-up contribution, you're claiming a tax deduction for $87,000. So that's a number of years worth of that $27,500. Then the amount that you're actually getting taxed on is about $105,000 rather than the $195,000. So in this particular example, the net tax saved, because there's two elements here. There's how much tax you save in your own name, but then there's the tax that the superannuation is going to get taxed on at the 15% tax rate. The net between those in this particular example has just saved about $15,000. So can actually be quite a significant planning tool if you've got a capital gain that is expected to be incurred on the sale of an asset. Worth having a look at what your superannuation system is. Has to be in the same financial year. I'll just note that as well. Okay. Now, what if you exceed your concessional contribution limit? So what if you exceed that $27,500? Essentially, it used to be that there was really, really harsh penalties associated with going over that limit. It's not as significant now, but there is still a little bit of a penalty. But essentially what they're doing is they're basically saying, hey, we're just going to get you back to what you would have been from a tax position if you hadn't have gotten that tax deduction to super in that year. So it's just to try to neutralise it. And there's some formulas behind the scenes, so it might not be exact, but that's the main gist of what they're trying to achieve. This is one of the reasons why we've had more of a tendency to use the personal tax deductions for super contributions rather than relying on your employer to make those contributions and salary sacrificing it, because the employer contribution patterns aren't necessarily as consistent or reliable. So you can't always calculate them precisely enough to make sure you get right on that $27,500 deduction. Whereas if you let your superannuation go through normally using the superannuation guarantee at your employer level, and then you make a personal contribution to top up your super, and then you personally claim a tax deduction for that, you can control how much you claim a tax deduction for so you don't get penalised at all. It's a few more steps and it is more complicated, so you possibly need some help with that, but it's sometimes a better way to get control of that situation and maximise things to the nth degree. The reason why that is so important is because the superannuation contribution, the concessional contribution limits are measured on a cash basis. It's not based on when your employer has taken the allowance, if you like, out of your salary. So they may take the allowance out of your salary. You get your salary paid into your bank account. They've not paid your superannuation. They may not pay your superannuation till the next month. So there is potential for a timing difference in when that superannuation payment actually gets into the superannuation fund's bank account. And it's not until it's actually in the bank account of that superannuation fund that it's actually going to count towards this limit. So around 30 June, sometimes employers will get in just before 30 June, or they may miss that deadline. If it goes in on the 1st of July, even though it may have come out of the employer's bank account on the 30th of June, it doesn't matter. It's going to count towards the following year. And that might actually cause you to double up on your contributions in that following year. So it just makes it a little bit trickier. So just something to keep in mind. Okay, this is the personal contribution that I was mentioning to you. So yes, the extra steps are involved there is this notice of intent to claim form. And I really cannot stress enough the fact that you need to make sure that you lodge that with your super fund very shortly after 30 June. Once you know what the super contributions are from everywhere else, you'll be able to get that number very precise. But you do not lodge your tax return until you have received a confirmation back from that superannuation fund that they have received your notice and they have processed it accordingly. There's been a lot of cases going through the courts recently where people have just missed the timing of that, or their form didn't get accepted by the fund, or they didn't receive it for some reason, a problem with the mail, who knows, and then their deduction was actually denied at the tax office level. So you just need to make sure that you take those steps and do it all very precisely in order to not trip up and have a tax problem as a result. You can actually also do some things to help your spouse. So there is a thing called superannuation splitting. So as I mentioned to you before, there is this $1.9 million level where it's basically deemed by the government, if you like, that that's sufficient for you to have in superannuation and us give you all the tax concessions associated with it. So as soon as you go over that $1.9 million, there's limits on how much you can have in pension mode, but there's also those limits associated with being able to put additional contributions from your own money into superannuation once you're over that $1.9 million limit. But that doesn't mean you can't put money in under your spouse's name. And this is where super splitting can be potentially useful. You can actually split your concessional contributions across to your spouse so that it's going against their $1.9 million limit. So you're basically helping to even up the balances. So that can sometimes be quite a useful tool, particularly if you've got one spouse that's got a large superannuation balance and the other has got a very low one. There's also some spouse contributions that you can make and you get a bit of a tax offset, so that can sometimes be useful. And also for low income earners, so if you're under $41,000 of taxable income, then you might get a $500 co-contribution from the government, if you like, it's almost like a negative tax, by making a non-concessional contribution into that low income person's superannuation of $1,000. So it's like getting a 50% negative tax bill. They're actually giving you a tax refund. So it's a really quite an interesting incentive if you fall into the eligibility criteria for that one. Now, downsizing is the other, I'll call it main category that we come across where you can actually put a big lump sum into superannuation if you wish. Downsizing is basically involving you selling your family home and then using some of the proceeds from that family home to put into super. Now, the whole terminology of downsizing is a little bit misleading. A lot of people think, well, I went from my $600,000 home, I sold it, and then I actually finished up buying something for $650,000, so I didn't actually downsize. Can I still use this? Well, the answer is yes, you can, because the criteria in the law, if you like, is simply that you have sold your family home or a property that has been your family home at some point. So it has to be qualifying for the principal residence exemption for some of the period of ownership. Okay, that's the rule. You also need to have owned it for a minimum of 10 years. So this is not where you can keep flipping family homes and keep rolling this through. Okay, so you've got that is basically the criteria, those two criteria. Then you need to make the contribution. If you're wanting to take advantage of this, you need to make the contribution within 90 days of settlement or of when you sign the contract. So whichever you wish. The later one is usually the 90 days from settlement date. So you need to really be knowing that you're going to use this before you settle on the house so that you've got plenty of time to put your affairs in order so that you can actually use this concession. The amount that you can put into superannuation in this example is up to $300,000 per person of that couple. That is actually regardless of whether the house that qualifies under this criteria was actually owned in one or the other or in joint names of that couple. So for example, if I owned my home and I sold it and we decided to, and we've qualified under all the other conditions, I could actually make a $300,000 contribution for myself and my husband if I wanted to, even though the house was actually only in my name, or vice versa. So that's an interesting tidbit, okay? Now, this only applies for people who are over the age of 55 when you sold the property. That limit used to be 60, but then on the 1st of January 2023, they reduced that limit down to age 55. So once again, when you're getting closer to retirement, you might be downsizing because the kids, have left home and you just don't need that size property anymore. That could be a really useful tool to actually start building up your superannuation balance with a bit of a rapid injection of cash. Now, that $300,000 amount, as it goes into superannuation, is going to be treated the same as a non-concessional contribution in that it's not taxed as it goes in. However, it does not have the limitation of the $1.9 million that we talked about earlier, where if you're over $1.9 million, you can't make non-concessional contributions. even if you're over 1.9, you can actually make this particular $300,000 contribution. So once again, an interesting tool that you might be able to utilize. So strategies to think about. This is how we're going to sort of just wrap up our session today. So strategies to think about. Once again, I cannot stress to you highly enough that superannuation is a really fabulous tax effective environment to actually have your savings for your retirement. But it is equally as important to actually have a goal that you're working towards and have that target be really tangible and be meaningful to you and the lifestyle that you want to live in your retirement. But incorporating superannuation as part of that larger plan is really important because of the tax benefits, the ability to plan, the ability to have cash flows and being able to manage, cash reserves, etc. You need to be able to understand what the future capital gains implications of where you hold assets are. Once again, if you've got a long-term hold type of asset, and I think we quite often use property as an example, superannuation can be a really important or really useful way to hold that sort of property, particularly if you don't intend to sell that property until you retire, which means that in the super fund environment, it could actually be capped at a 0% tax rate. So once again, it's too good not to be thinking about in advance. It is important for you to diversify your investments, particularly as you go into your retirement mode, purely because that helps with the cash flow and it helps with risk diversification. There's a lot of reasons why that's important, but that doesn't mean that you have to be diversified. You just need to sort of have that as part of the things that you really give some really good consideration to. And of course, with any investment profile or portfolio, regardless of whether it's inside superannuation or outside, you need to take into account your own personal risk appetite and your needs and objectives. And ultimately, this is about making sure that we make the best of your retirement and your opportunities and just basically getting it in the right environment so it's as tax effective as possible. Tax saved is as good as money earned. So, making sure that we make that as tax effective as possible is really important. How can we help? If you've got any questions, I've noticed that there's no questions come through in the chat. If you've got some questions that might be a bit more personal to you, feel free to shoot them through to the email address on the screen there, team@tagfinancial.com.au, or give us a call to have a chat about your individual circumstances. We are off the back of this webinar. To anyone who came along, we are offering a complimentary meeting. Now, that could be that you come into the office and have a chat to one of our advisors, or just have a phone call for 20 or 30 minutes and talk about your specific circumstances and how we might be able to help. So feel free to take advantage of either of those two opportunities. Join our online community. We're getting emails and blogs about all sorts of different topics on a regular basis. So if you've joined our database, then you will get those via email, and what have you. And also find us on Facebook and LinkedIn. Connect. That way you get access to some of the materials that we will release that way as well, and access to special webinars and what have you on these types of topics. So without any further ado, I'm going to finish the broadcast now, but please do reach out if you have any questions at all. We've got a fabulous team that can help you with all sorts of different questions and concerns. We've got a business advisory and tax team, our investment and wealth team, our specialist superannuation team. We've also got resources in the estate planning, including wills, where we can actually connect you with lawyers that can help you with that. And we've also got our in-house home and investment loan broking service. So feel free to reach out if any of those services might be of interest to you. It's all about helping you in that financial journey. Thanks for coming along today, guys, and hopefully we'll see you again soon.